Good morning, everyone. We're really pleased to have you with us today. Today, this is John Gale interviewing Stewart Noakes. We're going to talk about his role as an angel investor and how he makes decisions as an angel investor. Stewart's a very interesting guy. He co-founded the Canopy startup accelerators in Boston, Exeter, and Lisbon. He has experience in building and exiting startups and scale-ups in India, the UK, and the United States. And he's worked in more than 16 countries. He's also a member of Concept, which is an early-stage UK-based VC firm which has made over 20 investments in the last 2 years. Stewart's now living in Lisbon with his family and launching the Canopy incubator that he co-founded. Stewart?
Thanks, John. It's great to be here today. Thanks for having me. And for those of you that are watching today that don't know much about John, just a few words of introduction to him today. It's been great to meet somebody with the kind of experience that he has. And certainly it's very beneficial for people here in Portugal to kind of leverage the background that he has, extensive experience with startups and corporates, over 12 years in Silicon Valley, and working in all sorts of stages with people and with companies that I've not had the experience with, people like NEC Electronics and IBM. This is the sort of experience that Portugal really needs to add value to the really fast-growing ecosystem here right now. So thank you very much, John. I've learned a great deal from you over the last 6 months, and it's great to be here today.
Well, great. Thank you, Stewart. As an angel investor, what do you feel is the key added value that you bring to a startup?
Well, basically, John, I would say I've screwed a lot of stuff up. I've got a few things right. I've made a bit of money along the way, and I've worked with over 200 different startups. So I would say that the number one value that I add is actually the time that I invest in and sharing that experience and helping people learn from the lessons, successes, and failures that I've made. I think that's always the primary piece of value, and any money involved is always the secondary piece.
Okay, great. How much do you invest in a startup? And let's talk about which round you're investing in. You're investing in the very first seed round. So let's talk about how much you invest.
Yeah, so I invest in a couple of different ways. So if I talk sort of a private personal perspective, I'm a huge believer in equity crowdfunding. I like to get involved in a number of different deals through that way. And through there and through some private individual investments, I think I've done 8 to 10. I think 10 in the last sort of 2 years. Since my first exit 4 years ago, I've done that sort of stuff. Before that, I didn't do it at all. And then through Concept, we've invested in, I think it's 22 companies over the last couple of years. I've been involved in the latter half of that. Ticket size that I'm comfortable with is the sort of 20 to 50,000 range. And that's in a mixture of cash or actually involved in services or time involved from me as well. So but a number of different ways across the different companies, and no sort of one-size-fits-all strategy for me at this point.
Okay, great. So you said you'd invested in 11 startups on your own and maybe half of the Concept investments?
Yeah, been involved with the Concept stuff, yeah, for about the latter half of the investments, yeah.
Okay, great. So what are your core interest areas in investing? Do you invest in high tech or low tech or e-commerce or AI or what?
So, I mean, you can talk about the different groupings. So I really like things like equity crowdfunding, and I've invested in companies like Crowdcube along the way with that. I like companies that I have empathy with as a target market. And I like tangible things. I've done a lot of stuff around food, actually, and things which you can see and touch. And I've got involved, actually, a nice vehicle in the UK is bonds, where you invest in growth fundraising for a company. I think the most famous one in the UK, not that I was involved with that, was the Burrito bond that did very well.
Are you talking about the equity crowdfunding that's bonds? I saw that website a few months ago. That's very interesting.
Yeah, so equity crowdfunding is obviously where you get a stake inside the company. The bonds is where they crowdfund the bonds, and you get a return somewhere in the 8 to 10% range from that, and it's paid out on a quarterly basis. It's a relatively high risk area, which is why you get the 8 to 10. But interestingly, none of the bonds that I've invested in through the platforms have failed yet. and they've all paid out on time, which has been great. And in the UK right now, if you go into a super high interest account, you might get like 2%. And so if you're getting 8 to 10% through these bonds, it's a definite win. In the concept stuff, we look for what we call non-technical founder teams. So that's people who have high empathy with their target market, who have a nice idea, sometimes incremental, sometimes disruptive, and who don't have the technical skills or co-founders to actually build it out. And we get involved with them by investing in time and development resource and energy from us to actually structure the first sort of 6 to 12 months of what they're doing, build the MVPs, and curate kind of concierge MVPs, and help them achieve some very quick and very successful market validations.
What sorts of startups do you avoid? In other words, do you get involved in very long-term things such as life sciences, or are you doing very short-term things? Where are you?
So personally, I like to see some sort of return of value and some sort of exit happening within 24 to 36 months. So I tend to avoid things that have longer tails than that. Things like life sciences, I would stay well away from. And things which are brand new, first-time disruptive things to market, I would also stay well away from at this point. That's not in keeping with my risk profile.
So, Stewart, how do you evaluate a team when somebody comes into you with an idea? What do you look for?
That's a great question, John. I think team is one of the hardest things to get right. And over the last few years, I think I've evolved a lot from how I used to look at teams originally. So, huge believer in the idea that you find character first and then look for skills second. And I believe that in hiring as well as investing. So I look for good people with good hearts and good brains. And then I look in a team, I look for a bit of diversity. And I look for a certain size of team as well. So I like 2, 3 founders. Three's a good number for me. I don't like to go over 5 or 6. Because I think that gets too complicated, and I think sole founders, top out generally a bit too quickly. Always exceptions to every rule, but for me, 3 co-founders is great, and I like at least 1, if not 2 of those people to be women. I find generally that to be a correlator for success in the investments that I've made, and I think a lot of that has to do with the empathy that goes with the market, and things become a little bit more market-centric than engineering-centric when people have the diversity of skills. I don't like to see 3 engineers come with an idea. I like to have somebody who's got a bit more of a kind of sales focus, somebody who's maybe got a vision and a bit of a decision-making background, and somebody who's got the engineering background in that team. So I look for all those things, and I also look for a little bit of chemistry. So an ability to talk to each other, to like each other. Going to spend a little bit of time together doing some things and covering some difficult ground. So I like to actually have this kind of rapport thing going on.
So how do you try to determine whether or not they're coachable?
Coachable, such a hard thing. So really, the first test that I do when people come through is I talk to them about their customers, the people they think that they're going to be helping and solving problems for. And I listen to them. I listen to how much they've actually talked to their customers, how much they understand about their customers. I love it when they are the demographic that is their potential customer base. And then I ask them questions about those customers, extensive questions. If they haven't talked to the customer, I then encourage them to go and do so. And if they don't talk to the customer, then they're pretty much off my list from that point. But when they do go to the customer, I like to see how much they understand, the depth of understanding they take it to, and the empathy they really have with that target market. If they can do those things and they can adjust during our discussions, then I believe that they are ultimately coachable. If they don't respond favorably to that kind of questioning, if they get too rigid, too fragile, too stuck in their ways when we're talking like that, then for me, I don't think they're going to be coachable or very good over the sort of short term, because ideas are great. But one thing I know from working with several hundred startups in their early phases is that the idea will change many times. It's unlikely that the co-founding team will change that much in the first couple of years, but that idea is going to iterate, change, pivot, and generally be different 6 months from the point where we're talking. And I really like to see that flexibility in their mindset and their DNA before we get going.
What's the real evidence of market traction before there's paying customers?
Well, there's not always that much traction when I get involved. In fact, we call this a kind of pre-seed round. It's almost like a replacement for friends, family, and fools, that we get involved that early sometimes. And what we're looking for there is the empathy before the customers, and we'll get involved in building what we would call a concierge MVP. Very often that's using third-party free software, WhatsApp groups, type forms, Facebook groups, these kind of things to find and tune the messaging, and getting people to say yes. When they say yes to it, that can be signing up for something, that can be responding to a newsletter, that can be accepting an invite to a WhatsApp group, or filling in a type form. And that's early traction for us. And when we see that, then some of the money will follow, and some of the extra kind of investments around development things will follow. But all these things can be broken down into stages. And I wouldn't say there's a robust one-size-fits-all formula for a way to get a startup from idea through to MVP. But there are things that you can break it down into to make it more of a speedy iteration process, and something that if it's going to fail, is going to fail fast, and that you can then build upon to actually move towards the MVPs and then the traction that you're looking for, like revenues.
Kawasaki said that he thought you should get into a startup, you should work as hard as you could, and in 6 months you should either decide that you are ready to cash out, or you should quit and do something else instead. Now, that looks a little fast, but what you're really saying is you want to see strong evidence of value in 6 months.
Yes, absolutely. And for me, as a pre-seed or early stage investment, most of the time I'm looking for my personal exit over the 24 to 36 month period. And that first piece of MVP, getting the traction, 6 to 12 months is my personal benchmark. I've seen a company here in Portugal, which I use as one of the benchmarks, actually achieve that level of validation within 3 months. Off of about €4,000, and I've seen them raise a significant seed round off of that traction as well. And so I know it can be done, and I know it can be done by people who are non-technical founders as well. So, and I believe in the ability to repeat, or at least offer up that benchmark against the progress of the startups that I'm involved with.
So at that early stage, how do you want the startup CEO to have thought about potential market size?
So I want them to have thought about it. I want them to have achieved a kind of logic chain from where they're at now to the sort of maximum revenues they could have pulled in, and who their customers are, and kind of what market they're in. But what market or what business they're in can change an awful lot over the first 6 months. And the pivots and iterations can change you from a B2C to a B2B, and back again to a B2B2C, and all sorts of things. Even the country that you're going to address first. A lot of startups that begin their life believing they're going to pilot projects in Portugal may in fact be better off launching in the UK to begin with. And the market size, the addressable market size that they'll go for in the first 2 years will be incredibly different. So I like them to have thought about it and established a logic chain, but I also like them to understand that they're going to change their mind, and they're going to change the direction of the company so many times in the first 2 years that they don't have to stick to what they're thinking about right now.
So several early stage startups that have talked to me have been wanting to launch B2C, and I always see B2C as being more expensive to launch than B2B. So I encourage them to look at whether or not there's an opportunity to launch as a B2B initially in order to generate some easy revenue, and then expand into B2C later. You want to comment on that and how it relates to the ones you look at?
Yeah, well, interestingly, actually, a startup that I've been involved with recently, they have both B2B and B2C elements, and watching their launch, and they're only 4 months in, each of the elements goes at a different rate, and I've been surprised that their B2C has actually acquired customers a lot quicker and a lot cheaper than the B2B.
Wow.
And sometimes the engagement cycle on B2B, the challenge is actually the time it takes to get the decision made, and also the decision-making change within organizations. So particularly if you're going for a kind of corporate side. Whereas B2C decision change can be a lot quicker. Obviously, people can make the decision to spend their money. Depending on the price point, it gets easier and easier the cheaper that price point is. I have more experience in B2B than I do in B2C, so I favor B2B a little bit more, but you always go with what you know, right?
How do you want these people to have thought about their competition, and how much do you want them to know about the competition at this sort of embryonic level?
Well, it's great. It's a great question. One of my alarm bells is when people say they don't have any competition, because if they're solving a problem, somebody's either it's got to be aware of that problem already in some way, shape, or form, and is doing something to avoid it or to compensate for it already. And even if that avoidance is doing nothing, there is a competitor there somewhere, right? And so I get a little nervous when they say they have none. I like them to have thought about the competitors that they can see, as well as the ones that are kind of implied competitors or the avoidance competitors or the alternatives that people are doing as a result. You know, you might say, hey, I'm the only car service between Lisbon and Cascais. It's kind of like, well, yeah, it's because people take the train. Okay, there's a competitor. You didn't maybe think about it. You were thinking about Hertz, or you were thinking about Uber, or you were thinking about Cabify, but you didn't think that people were going to take the train. It's a trite example, you know what I mean? But I also like them to recognize that as they pivot and change what they're doing, the competitor landscape will change. So as an example, if they believe they're B2B right now and they're changing to be a B2C, the competitors and the implied competitors will be different again.
What sorts of questions do you ask them about barriers to competitive entry?
That's a great question, John. Thank you. Barriers to competitive entry, I think because I like these people to be their target market. I think they have instincts around the barriers to entry rather than defined kind of barriers. And I actually don't like them to have thought too much about it. I like them to think about the problem. I like them to think how they're going to solve the problem. I don't like them to think about how they're going to beat their competitors. I don't know if that makes sense to you, but it's the idea that I want them to fixate on making happy customers and almost forget that there's a competition. Just worry about getting that yes. Just worry about getting that smile, and let the competitor do whatever the competitor does. I was mentoring somebody recently who had a bit of a panic attack when they saw that somebody was doing exactly what they were doing in the same city that they were doing it at the same time that they were doing it, and that competitor was actually stealing some of their branding and actually trying to poach some of their early stage staff. And my advice to them was just don't worry about it. If they're good and you're not good, they're going to squeeze you out. Just worry, though, about that customer and making that customer happy and listening to that customer. Because if you listen to that customer better than the other person, you will win.
But this applies primarily because you're talking at such an early stage. 6-12 months later, it would be different.
Potentially, yeah, absolutely. The reason I like this early stage stuff is because everything is up for change, everything is up for grabs, and it's an incredibly kind of personal and driven by the founder's time. It's less process and less operational, I guess you would say.
How do you want these people thinking about financial projections?
It's very similar to kind of the business planning stuff for me. I like them to have thought it through. I like them to have the logic chain. I like them to be aware of where they're trying to take things. But I like their goals to be much more around kind of unit economics. I like them to be focused on things like cost of customer acquisition, looking at the lifetime value and looking at the repetition of purchase and involvement from the customers. I less like to hear, hey, I'm going to make $1 million in the next 3 years, and those kind of progressions.
If you invest, say, 30,000 euros, a key issue, of course, is how are they going to spend that and how they're going to describe that to you beforehand. Is it fair to say that most of that money is going to be spent on early MVP and customer acquisition?
Yeah, I like to think that it is, and I like to think that the majority will be spent, and certainly the front loading of the spend will be on marketing and market acquisition, and the later spends will be on the actual development and product side. I like it that way around because I think if you can find the customer and acquire them and then build something for them, some people might call bake it before you make it or sell it before you bake it, however you want to look at it, but it's I think if you can find the customer and acquire them and then put a product in front of them, that is the better way round than trying to spend a lot of money and time building a product and then trying to find a customer who'll take it.
Okay, so this approach of yours is only going to work with some types of business models. It's not going to work for everything. So,
Absolutely. And I don't invest in everything. And I tend to avoid the sort of things like long-term investments in AI or health, life sciences or something, which would require a slightly different approach.
okay, so you're looking for the unique way to make a significant delivery of value in 2 to 3 years.
Yes, absolutely. And I would say, though, I have a diversity to the things that I've invested in, but the ones that I get actively involved in, as well as putting some money into, these are the ones that I like to see the 24 to 36-month return.
How do you want them thinking about, multiple revenue streams or future revenue streams when you talk with them?
Yeah, so I mean, it's that whole telescope thing. From where you are now, it's a very long way away to be looking. When I'm talking to somebody in the idea stage or early MVP stage, to be looking past the sort of Series C or to be looking to the multiple revenue streams, it's a hard thing to do. I like them to have thought it through in their heads about where it may go. I don't want them to be fixated about it because things are going to be flexible at this stage and they're going to change a lot. If even your market is going to change, if even your type of offering is going to change, then those alternative revenue streams may be very, very different to the ones that you're thinking about right now. And I like them to think about the stages from idea to seed, from seed to Series A, from Series A through VCs and so on. I like them to think of each stage as a plus one. They're going to add a different type of feature, a different type of demographic, a different type of revenue stream in each one. I don't want them to add all three of those at the same time. I want them to incrementally change between each stage. And I like them to bring a narrow plan for each stage to bear, because we can over-deliver on a narrow plan. We can't over-deliver a complex and wide plan. So I like them to think about maybe a B round to be where they're putting very alternative streams in. But in the seed and the Series A, where I'm involved, I like them to think very narrow, very singular, very plus one all the time, not plus five, not plus 10.
How important is it that the focus of the team in terms of their knowledge base and what they're trying to do in terms of sector and, say, functional area, how important is it that that fits well with your experience?
Yeah, I think for me to add value, it's good that I have experience in those areas already. I think this kind of knowledge and experience of both failure and success is very important to how I add value into an investment and for them to want to have me as an investor. The other side is if I already have investments where this new startup can add value to it, then I like to get involved with those as well. And I don't, as I say, I think my experience is the primary value that I add at this stage, and the money is a secondary. So if it's all about money, then I'm not the right investor for that group. And there are plenty of people that will be. That said, on a private basis, when I've done investments a bit more blind, say through things like equity crowdfunding, there I'm basically holding things at arm's length and not adding particular value. But it's interesting that I get great engagement from those kind of investments where they are soliciting help and providing information very proactively through Facebook groups and regular mailers. So even though I'm holding myself at arm's length and not actually providing that much, I'm being asked for it, and as are the other shareholders, even very minor holdings. Big fan of a company called Grub Club in the UK, and even if you put 10 euros into that, you have access to an investor-only Facebook group. You're provided with at least a quarterly emailer about the main challenges and things that are going. You get a personal email and a personal report from the CEO. And part of the crowdfunding, when you put the money in, I think if you went over, I want to say I think it was £2,000 on the subscription, you actually got an invitation to a personal dinner at the founders' homes of Grub Club, which is a great piece of engagement, right?
Okay. Do you like to invest in the first of a kind new idea that's sort of a totally different disruption to an area, or do you like to invest in an incremental enhancement to something where there's an opportunity for selling to an existing market?
I guess I'd say I'm probably 90-10 on that. I'm probably 10% on things that are disruptive and 90% on things that are incremental. I'm a big believer in equity crowdfunding, and I've invested in a couple of different things around there. And I've also invested through equity crowdfunding in a number of things, in even small ways. But most things that I've been involved with in concept and in my kind of professional side of investing has been around incremental changes. So things that have existing markets and understood markets. And I enjoyed looking at things from some markets that aren't necessarily disruptive there, so say in the UK or the US, and then taking them to places like Portugal or India where they are disruptive or seemingly disruptive in those spaces.
Okay. Will you ever invest in an offering that's a nice to have from the customer's perspective, or do you always want that offering to be a have to have from the customer's perspective?
Well, from the customer's perspective, I always want it to be a have to have. But I would say probably the most. I'm not the target demographic for one of these investments that I've made, but it's around. I've been involved with a company that's delivering beauty on demand services, and for me, I would say beauty on demand is an optional thing. But for the target demographic, they would say beauty on demand is a have to have, it's a mandatory, and something about the frequency of repetition around things like pedicures and manicures makes it a must have. But as I say, I'm not the target demographic, but I really recognize the power of the consumer on this one, that every 2 to 4 weeks they're repeat buying through the portal.
Okay. How do you think about intellectual property in this stage of a startup?
Well, I think this is a great area, and it's an area that actually I haven't done that much in. What we've taken a philosophy on today has been to execute quicker than the other guy. And to do some sort of basic stuff, usually around trademarks and kind of branding, but not actually to protect that much within them. And I guess it's also reflective of the kind of markets that we're in, with incremental change rather than transformational, and also the speed at which we're executing and exiting, sort of 24 to 36 months. I've been looking a little bit recently around things like how can you actually protect a process or a way of working to go on top of this. But in general, software is a very tricky area for this protection, and I'm learning a lot on it. I think possibly the future will hold a little bit more for me in this area.
In thinking about business plans, what sort of business plan do you want these people to put together? I mean, I really like the guy who puts together a 30, 40-page business plan and then boils it down to 10 PowerPoint slides, because I feel he really knows what he's doing at that point. But at an early stage such as you're talking about, I suspect they haven't done that much.
Well, it's amazing, actually. We've had all sorts of different things come to us in the past, everything from the back of an envelope through to 50, 60-page plans. And the main thing I'm looking for in any business plan or in the team that create the business plan and present it to us is their belief in that plan and how well they can articulate that plan without reading it like a script, and also their flexibility around that plan. As you say, if somebody's built out a 40, 50-page plan, spent all that time on it building it, and then they've condensed it back to a sort of 10-page PowerPoint, they're going to know that plan inside out, the assumptions that they've made and the things that they're trying to do. That's going to change an awful lot in the sort of things I get involved in. If they're at idea stage with a plan like that, they can probably rip it up now for the amount of value it's going to last for over the next 3 or 4 weeks with the iterations and the changes they're going to make. The process that they've gone through will be very useful, and the logic trees that they've connected up in their heads and the kind of facts and figures they've built together from their research will be useful, but they shouldn't be fixated on it. They shouldn't be rigid with it. They shouldn't be fragile about changing it or protective of it. They should simply see it, for me, as a stake in the ground of where they believe they're going to go, and then we're going to change that over the next few weeks and months.
You've got a couple of different investment processes that you use when you're making an angel investment. Can you go through the different steps of each of those so that the viewer can get a better understanding of what the process would be if he got involved with you?
Yeah, well, I can probably speak most strongly here to part of the process that we put together inside Concept, which I think is very effective. I think the first piece of contextual information to provide here is that every investment company, including Concept, which is relatively small and early, and every investment company has more stuff come to them than they can possibly invest in with the money and time that they have available. So even for us, I would say we're evaluating 10 times more ideas than we can possibly actually invest in. And that seems crazy, right? So the first filter for us is kind of a gut sense check. A quick read, the first few lines or first half page and a gut response. Is that really where I want to go? Do I feel excited about it? Is it something I want to read more of? Do I want it? And then there's two piles, well, three piles really. There's the absolute no's, there's the maybe come back to, and then there's the ones that I feel that we're going to be going forward with. Every partner in concept has a different view, and they each have different piles, and kind of bringing them together. Then we'll look a little bit further into the detail, and then arrange some sort of Skype call or face-to-face, and then a follow-up face-to-face with at least one of the partners to really get under the skin of the team and the ideas that they're putting forward. From there, the most effective tool that I've used inside Concept and outside today is to have what we call a selection day, and to bring people together, all the investments that we're looking at in that cohort together at the same time, and to let them present to us at the same time as presenting to everybody else, and to do it in a very stripped back version in the sense of no slides, no screen, nowhere to hide. We actually did the last one, standing on a rug in the middle, almost like charades, in the middle of a big circle of other investors and other people looking for investment. And to then do very open dialogue Q&A with everybody being able to ask questions of everybody. And so what we're doing there is we're basically crowdsourcing the understanding process. We're looking through the eyes of other people, through the filters of other people, and we're exploring through their questions, which is sometimes, it's amazing how one or two questions will come out that we as investment partners would never have thought of asking, that really open up that idea or open up the potential of that idea. And from there, we move into a process of the offer. And even in the process of offer, you can lose potential investments because it's not a good fit. Either they're looking purely for money and they're getting different to that, or they're not looking for the same level of involvement that we're prepared to give, or maybe there's not the right chemistry. This isn't, again, it's a bit like hiring for character and then training for skills. Investment is as much about the chemistry between the people on the founding team and the investment team together as it is about the money involved or the project that you're on.
So I think one of the messages that comes through there is you're really looking for a startup CEO who thinks well on his feet. You want him to be able to stand in the middle of a circle and project and defend.
Yeah, but there's an authenticity that we're checking with that. So, hey, I've built a great business plan, but I don't really believe in it. Okay, well, we can scratch and sniff that pretty quick. I want you to tell me in a couple of minutes about your business plan and your objectives, and I don't want you to have any slides or fancy graphics. I don't have any smoke or mirrors. I want you to tell me what you believe you're going to be able to do. And if you can't remember what you're going to do you believe it?
Okay. Interesting challenge for them to go through. Talk to me about valuation in an early stage startup like this. It seems to me that it'd be fairly ephemeral. It
is pretty much impossible to objectively value the company at the stage that we get invested in. It really is. So I'm a big believer in things like convertible notes, which defer the ultimate decision. We have a kind of tolerance, a thing that we're trying to achieve inside our portfolio on a personal basis, and the concept stuff that I've been involved with and the other investment companies I've been involved with. There's always a goal that you're trying to achieve in terms of return. And so there's a level that you want to get in. There's a minimum level you'll get in at and a maximum that you kind of expect to be reasonable within that investment. We don't try and overgrab, but we try to be proportionate to the value that we're giving at the risk level that we're giving and the timeline that we're giving. So, and if we can't reach an agreement where both sides are comfortable that is really the right approach, as in they're giving up the amount of equity they're comfortable with, we're receiving the amount of equity we feel is right for the value we're delivering in money and in time, then there's no deal to be done. And as I say, there's a big queue out there of ideas coming forward that wants investment. And if we can't find the right deal today, well, then we'll go and find the right deal tomorrow. There's enough to be looking at that there's bound to be the right deal in there somewhere.
Are you investing with a convertible note or common stock or preferred stock or something more esoteric? How do you do this?
Yeah, we've got no one size fits all, and I would say Concept probably did 15 different deals in the first 15 deals and suddenly has a bit more standardization to it as a model. And my preferred method at this point is a convertible note.
Do you syndicate deals with other angels or other early stage investors?
Personally, I've not been involved in that to date, and I think I would probably avoid that kind of stuff, but that's about my personal profiles and the fact that I'm giving quite a lot of time and involvement, and the syndication might dilute some of that time or confuse it. And so I've stayed away from that sort of thing today.
So you're really getting them to the point where they can launch a typical angel round.
Yeah, a seed and Series A rounds, yeah.
From your involvement, they might go directly to a Series A?
No, we'd usually look at a seed along the way.
Okay.
And just to explain a bit of my background, I'm a bit of a junkie for the first 2 years of a company. I find it the most personal and involving and engaging, and I get the most from it, which is one of the reasons I invest in those cycles. It's like creates for me my own personal Groundhog Day of involvement.
Mm-hmm. Okay. So how do you want these startup CEOs thinking about exit strategy when they come to you?
It's a great question, John. I think the simple answer is I want them thinking about it. And I know that seems odd, but quite a few people have never thought about the exit strategy. They've thought about the idea and the problem maybe, and they've thought about where they can take it, and they'll be global and it'll be amazing, but they haven't actually thought how they're going to exit. And I'm a big believer in a sense of responsibility and a sense of proportionality. So if somebody puts money into my company, or I put money into their company, there's an associated sense of responsibility for return, and most of the return will come through an exit process. So if my money goes into that company, I want them to be thinking as hard about the exit and the return to me as I will be thinking about it. At least to be able to nod to it and to know that it's in my focus, because they should be working hard for me and to return that money, just as I'll be working hard for them to achieve their journey. And so we don't know exactly when that exit will be or how that exit will be, but I want them to be thinking about it from the beginning.
So you've talked in terms of your interest in a financial exit in 2 to 3 years. Are you looking for 1x, 5x, 10x? What's your perceptions of what your ROI ought to be, and how does that work out?
So John, I mean, this is a slightly embarrassing one to talk about, because for me, my expectations are low. My expectations are X plus. So the way it works is X return to me in 24 to 36 months means I get to play again. X plus means I get to play again multiple times. And if I can get 2X or 3X, fantastic. I get to put some money in the bank and play twice for the one gamble that I did before. And that's what all of these things are. I recognize that in the stage that I'm investing in, at least 9 out of 10 will fail. And what I'm trying to do is improve the chances of success through my personal involvement and engaging with teams that I feel can benefit from that. If I get to play twice off the same money, that's fantastic. And if I get to play multiple times beyond that, great. But honestly, I go into each deal with the expectation, sometimes hopeful expectation, of X plus as a return. And I think most firms and big firms around the world will agree that X is an amazing return. And I think more than 50% of big VC funds don't deliver X in their overall fund strategy over 10 years.
So what sort of role do you want to play on the board of directors after you put in a commitment?
I like to be actively involved in the sort of 2 to 3 years that I'm there. I think once people have secured a Series A, I'm less useful to them. And that's one of the reasons I like to exit around that time, because I think my value is diluted there. I've gone all the way through scale-ups and exits, but I think I'm most useful in these early stages. And then I think, so from Series A onwards, I think I'm more useful as a non-exec to give some general counsel and to give some opposing views and some more entrepreneurial sides to the decisions being made, and to share some of the experience, but it's less involved and engaged. So I like to keep light boards for the first couple of years, and I like to be actively involved in those boards.
How do you judge if a startup CEO is trustworthy?
How do you judge if anybody is trustworthy? You simply have to trust in them and then see how it works out.
You're looking for a strong management team and a strong CEO. Is the team the single most important criteria for you?
Yes, it is. Yes, yeah. Again, it's about character and skills. I think the idea will actually change many, many times from the point where I get engaged to the point where I exit. But I think the team will stay relatively static. I don't think co-founder teams break up too much. And if they do, then that's going to be horrendous for the first 2-year journey. So I really like it when the founders have a strength of relationship, and a relationship they've believed in for some time and hold in high regard above almost anything else. And so, yeah, I invest in that team as much as anything. You asked me a question the other day about how do you find people trustworthy, or how do you judge if they're trustworthy? And I think that's a great question. And maybe I can answer it better today than I did last time. So I have a gut thing, and everybody has a different way of doing it. But my gut feel is after the first meeting, after the handshake to say goodbye, as I turn around, I have a gut reflex around whether or not I would trust that person with my children. As I walk away, if I feel that I could have left my 2 kids with them, then I put my trust in that person and I do it wholeheartedly. If I don't feel instinctively that I could have left my kids with them, then it doesn't go any further. And it's a pure instinct thing, but that's my benchmark. And that's my benchmark in life as well as in investments.
What sort of KPIs do you see as the most important for this early stage startup?
For me, KPI is all about the customer. So I like KPIs around customer acquisition cost. I like them around the repeat buying. I want them around the kind of lifetime value or the accumulative value that they're getting from those customers. And I really focus on those things a lot. And then secondary, I look at the actual unit economics within each purchase, about how much gross profit can they actually yield from each of those. But that kind of relates to the lifetime value and then improving that value related to the cost of customer acquisition. So drive a lot on the customer acquisition cost down and drive a lot on the lifetime value going up.
So we've finished the list of questions that I'd put together to talk to you about. Is there anything you'd like to add?
Well, I guess, John, something that's echoed throughout our conversations before and today, I really am a big believer in recognizing that when you take other people's money into your business, as I have in several and put into other people's businesses, that there's a sense of responsibility to focus on the return to that investor, and that it stops being a singular race of the entrepreneur to take their expression of business interests and creativity, and it starts to be a lot more about how you return expediently over time the money to those investors. And I really encourage everybody who wants to be an entrepreneur to get involved in it and to recognize that, it's an absolute blessing to be able to create your own businesses and to bring other people's money in to make that work. And to remember inside that blessing to really focus on the return of that money in multiple times if they can to the people that have lent and entrusted it to you. I think it's very important. I don't think enough people think like that, and I hope that they will after listening to our cast today. I'd also like to say thank you very much for the time today. It's been great. Thank you for the questions. I've had to think quite hard on some of them. Appreciate it.
Well, excellent. And so I'd like to thank all of you for watching our interview today, and thank you, Stewart-Noakes, for all the valuable information you provided. So this has been John Gale interviewing Stewart-Noakes on his angel investment strategy and his decision process. Thank you again.